Welcome guys. So this video I will be discussing Forex terminology. So the first thing we're going to talk about is a bull trend. Now believe it or not, when I started out trading, the bull and the bears used to always confuse me. I used to confuse up and down. And this is what I remembered. A bull has horns and a bull's horns points to the upside. So as simple as that might sound, I use that in my brain and I remember that a bullish trend is up. So obviously if bull is up, bearish is down. Besides the movement of a bullish trend going up and a bearish trend going down, I go into further detail later in the next video where I discuss market structure. So when the market is bullish, it makes higher highs and higher lows. When the market is bearish, it makes lower lows and lower highs. Okay, but I don't worry about that too much. I go in detail with that in the next video. Candlesticks. As much as you think you know about candlesticks and what they mean, I'm going to break it down for you what a candlestick actually means. So a green candlestick is a bullish candlestick. Green is the international color of the bulls. A lot of people customize the charts to blue, yellow, black, pink, whatever, but green and red are the international colors. So green is bullish, red is bearish. So with a bullish candle, that bottom of the body is actually where the price opened up. Okay, and the top of a bullish candle where the body closes is where the price closed. Okay, so let's say it was gold and it opened up at $1,300 and it closed at $1,310. That high point on the wick means that the price pushed up all the way to $1,315, but eventually it came back and it closed off at $1,310. So even though price opened again at $1,300, at the low end of the wick means that price pushed down to $1,290. Hope you guys are following me here. The same with the bearish candle on the right hand side of the screen. The high and the low means exactly the same thing on a bullish and a bearish candle. That's the highest the price went to and the lowest the price the bears could push it to. But the difference in candlesticks means that a red candlestick, which is bearish, opens at the top of the body and closes at the bottom. So that's the difference between a bullish and a bearish candlestick. Next up, we have lot sizes. Lot sizes, lot sizes, lot sizes. So many people get this, they kind of confuse it. This is a simple screenshot and layout. You can actually screenshot this, take a photo so that you never get confused. You have micro, mini, and standard lots, okay? Now, a micro lot is 0.01. So that means for every pip that the market moves, you will make 10 cents profit. With a mini lot, that is a 0.10. For every pip the market moves, you make $1. Then on the standard lot size, which is 1, for every pip the market moves, you will make $10 profits. So as you can see on the explanation in front of you, the more pips you catch, the more money you make, right? But someone trading the same trade as you, might not make the same amount of money as you. They might be trading a micro lot, which is 0.01. They catch the 60 pips on the exact same pair that you've traded, but they will only make $6. They've caught the pips, but the dollar value they will earn on the account is $6. If you were trading standard lot sizes, you would have made $600. Now, guys, understand that the same applies for when the market moves against you. So if the market moves against you, you're in a negative $600. So as much as it sounds good when the market is in your favor, remember that the negatives also look quite big on the bigger lot sizes. So depending on your account size, which I'll go again in further detail on another video, you'll know what lot size to use on what pair, when, and how exactly. Back to the pips. The pips. Cool. So there's a lot of definitions of how to calculate pips on the internet, and all of it always confused me. I have a simple method. It works for me. So use it, don't use it, but I use it. All my students use it and it works. So let's just hypothetically say AUD USD current price is 0.74500 and the market moves up to 0.74600, or we're predicting the market will move to that point in the next hour. Now, how did I get to 10 pips? Because if I look at that and I take the 0 and the decimal point away, it looks like 100. So all I do is I take the 0 decimal out and I just say 74600 on the calculator minus 74500 equals 100. all I always do is drop the last digit on the calculator to get my pip count. So let's look below that. AUD USD is 0.74500, pushes up all the way hypothetically to 0.75000, which gives me 50 pips. How did I work that out? I took 75,000 minus 74,500, which gave me 500. I dropped the last digit, which gave me 50 pips. Exact same for Euro USD, 1.16600 to 1.17600. It might look different. All I did was I took the decimal point between the 1.1, I took the decimal point out, and I said 117,600 minus 116,600. On my calculator, it showed 1,000. All I remembered, dropped the last digit, and that's how I got 100 pips. The one below that is a more complicated one, just to maybe throw you a curveball here, but it's still the same rules apply. Euro USD 1.16600, price hypothetically moves up to 1.20500. Now, again, I took my calculator, 120,500 minus 116,600. The answer on the calculator was 3,900. I just dropped the one digit and I got 390 pips. So guys, you can look at the explanation. You can see that I did it on every pair. The same with USD JPY, 109,500 to 110,750. All I did was take the decimal point out, typed in on my calculator 110,750 minus 109,500. The answer was 1,250. All I did was, again, drop the last digit on the calculator. Answer was 125 pips. Guys, that's the easiest way for me to count pips. I don't know if you have a better way, but that works 100% each and every time for me. Then we got the spread. Okay, so the spread is basically the difference between the bid and the ask price on a certain currency pair you're trading. Okay, so let's say you're trading with IC markets. They have almost zero spread. So if you press buy and the price is AUD USD right on the top, 0.74500, price most likely will open on 0.74499. Now maybe if you were with XM would have maybe had a 10 pip difference, so you would have opened up the price on 0.74490 or 480. So some brokers have spread, some brokers like IC markets have true ECN accounts, but they're not available everywhere in the world. So all depending on where you are in the world watching this, you need to find what broker is suited for your country. But basically, again, spread is the difference between the bid and the ask price on each pair. Swaps is basically your commission charges that your broker charges you for holding the pair overnight. So if you don't close your pair on the day and you hold it over 12 o'clock or 11 o'clock at night, that's if you're here in South Africa. Depending on what time the market closes, wherever you are in the world. When the market closes and a new day starts, you'll get billed a small percentage. A spread on a one lot, on a standard lot, I think is like, so not a spread, a swap fee is something like $6. The lower your lot size is, the less you pay. Sometimes like $2, $1, maybe even a few cents. Take profit is just a terminology of us where we set our take profit on our MetaTrader 4 apps. With the abbreviation we use is TP. We call it TP. Stop loss is where we set our risk. So whatever we're willing to lose in the trade, we place our stop loss, which we call SL. Longs and shorts are very similar to bulls and bears. So a bull trend is up, long means up. A bear trend is down, shorts mean down. So if I say I'm looking for longs on GBP, JPY, it means I'm looking for a buy opportunity. If I say I'm looking for shorts on USD, JPY, it means I'm looking for a sell opportunity. So next we have stacking and hedging. Now guys, funny story and sad story at the same time. Stacking and hedging was one of the fastest ways I blew my account when I started trading. Okay, so stacking is basically the opening of a trade while price is moving against you. So let's say you placed a sell on gold. Price moves up 20-30 pips. You place another sell because you believe it's hit a form of resistance. It moves up another 30 pips. You place another sell. And now you even double the lot size because you believe this is where the pair is going to just fall out of the sky. But that's not the case. Price keeps moving up against you. You keep stacking. and then eventually your margin drops to under 100%, and the broker closes your trades, and you blow your account by doing something so silly. So please, guys, do not stack. It's different when you're chipping in trades as price is going for you. So you're like $300-400 in profit, and you open another trade. That trade goes $300 in profit. You're now like $900 in profit, and then you open another trade. That's not stacking. That's actually chipping in trades that's going in your favor. Stacking is the placing of trades while price is moving against you. Hedging, also not a cool thing to do. Hedging is basically placing a buy and a sell on the exact same price. So you place a buy, sell, market moves up 30-40 pips. You will close your buy, but now your sell will be in a negative of 30 pips. You then place another buy and a sell, hoping the market will maybe fall in your favor, and then you would catch the next one, close of the previous one, and so on and so on. Before you know it, you're in so much buys and sells, you can't even think straight. Your account is red and blue, and then you sometimes end of the day just on break even. So all your hard work goes down the drain. You try to be clever, fool the system, but it just doesn't work, guys. So don't stack or hedge. Okay, so when you're on your MetaTrader 4 app and you go onto trade, and you go onto market execution. When you press on market execution, immediately you'll see a drop-down menu of sell stop order, buy stop order, sell limit order, and buy limit order. Now we'll get into that now. Firstly, if you click market execution again, you will then see bottom left is a red block that says sell by market. There's a blue block that says buy by market. Then there's also a stop loss and a take profit just below where your lot size needs to go into. So let's say you were trading a 0.10 lot size and your stop loss was whatever, take profit, whatever. You would then either press the blue button for an immediate open of the trade, which is a buy by market, or if you're looking to sell, you then press the red button, and that would execute and open your trade immediately. Now, this part you might want to pause, rewind, and write down. A sell stop order is the placing of a pending order when at below the market price. Okay, so a sell stop order is the placement of a pending order below market price. So what you're basically waiting for with a sell stop order is to catch the breakout and let your trade trigger and run into profit immediately. A buy stop order is exactly the opposite of a sell stop order. It's the placement of a pending trade above market price, hoping again that the market spikes up, triggers your trade, and you fly into profit. Now, the sell limit orders and the buy limit orders work a bit different. This is when you're anticipating a form of resistance or support where price might move to before it swings the other way. So with a sell limit order, you will place a pending order above the market price. So what you're waiting for is the market to move up, hit your sell limit, and then move down into your favor and catch all that pips that you were planning on catching. Instead of catching the 30-40 pip move in the bottom, you rather want to move up 90 pips, then hit your sell limit order and catch it down. Buy limit order, exact same, just the opposite. You place a pending order below the market price, anticipating that the market's going to find some sort of support there. Your trade then triggers, bounces up, and off you go into profit. Guys, personally, I don't use pending orders that much. I use it maybe 5 to 10% of the time. Most of my trades are used as market execution. So